At EPK Capital, our guiding philosophy is building wealth charge generations, a fiduciary discipline demanding vigilance across decades. Wealth preservation requires a defensive architecture against regulatory shocks, inflation, and tightening fiscal nets. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high-net-worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's get started now. We are at a historical inflection point for the Indian diaspora with the Finance Act 2024 and new compliance frameworks rewriting the rules for NRIs. The comfortable inertia of buy, hold, and forget has mutated from a passive wealth-building tool into an active liability. For high-net-worth individuals in the UAE or Africa, the implications are binary: adapt or erode. This report is an exhaustive treatise for sophisticated investors, exploring the interplay between India's Income Tax Act 1961 and international treaty networks. Wealth is not what you earn, it is what you keep. Let us begin the work of securing your legacy. Part I. The paradigm shift are the death of indexation and the new fiscal reality. The Finance Act 2024 shattered the indexation covenant, replacing the 20% rate with indexation with a flat 12.5% rate without indexation. While the headline rate reduction appears attractive, the mathematics tells a darker story for long-term holders in high-inflation environments. The grandfathering option, allowing taxpayers to choose the more beneficial regime, was restricted solely to resident individuals and HUFs. As an NRI, you are legally barred from claiming indexation on any property sold after 23 July 2024, mandatorily locked into the 12.5% flat rate on nominal gains. The exclusion of NRIs from the indexation benefit is a wealth erosion event, particularly for long-term holding scenarios. Consider Asset Alpha, a residential property purchased in 2005 for 10 million rupees and sold in 2025 for 50 million rupees. Under the old regime, the taxable capital gain was 18.9 million rupees, resulting in a base tax liability of 3.79 million rupees. However, under the new regime, mandatory for NRIs, the taxable capital gain is 40 million rupees, leading to a base tax liability of 5 million rupees. This results in a wealth erosion of over 1.2 million rupees for the NRI compared to a resident selling the exact same property. The Finance Act 2024 also restructured holding periods and rates, aiming to harmonize chaotic timelines across asset classes. The increase in LTCG tax on listed equity from 10% to 12.5% and STCG tax from 15% to 20% significantly alters the risk-reward calculus. A solitary glimmer of hope for NRIs is the foreign exchange fluctuation benefit under Section 48, neutralizing currency risk for Indian shares or debentures. Part 2. The ontology of residency defining your fiscal identity. The most dangerous financial error an NRI can commit is assuming residency is defined by their passport, not by the calendar. The classical 182-day rule for non-residents is the bedrock, but the government has tightened the net with the 120-day rule for HNIs with Indian income exceeding 1.5 million rupees. The deemed resident trap, introduced in Finance Act 2020, classifies Indian citizens with Indian income over 1.5 million rupees as residents if not liable to tax elsewhere. The government clarified that liable to tax refers to the legal jurisdiction's right to tax, not actual payment, classifying deemed residents as resident but not ordinarily resident. The RNO status is a powerful transitional shield, offering a 2 to 3 year window for returning NRIs to restructure global assets tax efficiently. The single greatest compliance risk is Schedule FA under the Black Money Act, requiring disclosure of all foreign assets for residents. Failure to disclose, even for zero-balance accounts, attracts draconian penalties of 1 million rupees per year and potential prosecution. Part 3. The Real Estate Fortress Protecting Immovable Wealth. For the Indian diaspora, real estate is an emotional anchor, but without indexation, it's a tax-inefficient asset if not managed with surgical precision. Section 51 allows exemption of LTCG from selling a residential house if reinvested in another residential house in India within specific timelines. The Finance Act 2023 introduced a cap of 100 million rupees on the exemption amount, and NRIs can claim exemption for purchasing 2 houses if the gain doesn't exceed 20 million rupees. A critical procedural requirement is the capital gains account scheme. Unutilized capital gain must be deposited into a specific CGAS account. Section 54F applies to the sale of any long-term capital asset if the proceeds are used to buy a residential house, requiring reinvestment of the net sale consideration. Section 54F has a sting. The exemption is denied if the NRI owns more than one residential house on the date of transfer. For retiring NRIs, Section 54EC bonds offer a tax-efficient exit ramp, allowing investment of capital gains in specified bonds up to 5 million rupees. The most immediate operational hurdle is tax deducted at source under Section 195, where buyers deduct 20% plus TDS on the total sale value. This means the tax department holds a significant portion of your capital as an interest-free loan, which can take 18 to 24 months to refund. The solution is applying for a lower deduction certificate via Form 13 before sale registration, authorizing a lower tax deduction. Part 4. The DTAA arbitrage or the UAE-Africa advantage. Double taxation avoidance agreements are sovereign treaties that override domestic law to the extent they are more beneficial to the taxpayer. The India-UAE DTAA is unique, with Indian courts upholding that liable to tax encompasses the sovereign right to tax, irrespective of the actual rate. Under Article 13 of the India-UAE DTAA, capital gains from Indian mutual funds by a UAE tax resident are taxable only in the UAE, effectively resulting in 0% tax. To claim this benefit, NRIs must demonstrate genuine substance, including a tax residency certificate, Form 10F, and economic nexus in the UAE. The African corridor presents a patchwork of treaties. For example, the India-South Africa DTAA offers a residence-based advantage for movable property. However, treaties with East African nations like Kenya and Tanzania often follow the UN model, allowing shared taxing rights, requiring foreign tax credit claims. Mauritius and Singapore offer grandfathering protocols for shares acquired before 1 April 2017, which are taxable only in Mauritius. CBDT Circular 012025 clarified that the principal purpose test will not apply to these grandfathered investments, providing massive relief. Part V. The mutual fund maze debt, equity, and the 50R trap. Section 50R introduced a new category for specified mutual funds, deeming gains from these funds as short-term capital gains, taxed at slab rates. This applies to units acquired on or after 1 April 2023, but units bought before this date are grandfathered under old rules. The India-UAE DTAA strategy becomes explosive here, overriding the 30% domestic tax with 0% tax for UAE-based UHNIs. Equity funds remain relatively tax-efficient under domestic law but have seen rate hikes, with LTCG at 12.5% and STCG at 20%. Part 6. Advanced Portfolio Engineering Harvesting and Stripping. Tax loss harvesting involves selling loss-making assets to offset realized capital gains, reducing net taxable income. Conversely, tax gain harvesting utilizes the annual 125,000 rupees exemption limit for LTCG on equity, allowing you to step up your cost of acquisition tax-free. Bonus and dividend stripping loopholes have been closed by amendments to Section 94 and 94, disallowing artificial loss creation. Part 7. The Compliance Audit 10 Cardinal Mistakes to Avoid. More wealth is destroyed by unforced errors than by market volatility. Here are the 10 most critical mistakes NRIs make. Mistake 1. The deemed resident trap. Assuming Dubai residency protects you even if Indian income exceeds 1.5 million rupees. Mistake 2. The Form 13 oversight. 20% plus TDS deducted on property sale value, locking capital for 2 years. Mistake 3. The NRO versus NRI blunder. Depositing Indian rent dividends into NRI accounts, which is a FEMA violation. Mistake 4. Indexation assumption. Expecting to pay 20% tax on property sales like a resident. Mistake 5. The joint owner risk. Adding a sibling's name to a property for convenience can be treated as benami or a taxable gift. Mistake 6. Ignoring DTAA on funds. Paying 30% tax on debt funds when UAE DTAA allows 0%. Mistake 7. Grandfathering confusion. Commingling pre-2017 Mauritius shares with new holdings. Mistake 8. Wasting Renault window. Moving assets to India immediately upon return, losing the 2 to 3 years of tax-free compounding. Mistake 9. Non-filing of ITR. Believing TDS deducted tax paid, missing out on refunds and carrying forward losses. Mistake 10. The FX gambler. Hoarding cash in NRO waiting for INR to depreciate, where currency risk often outweighs yield. the fiscal landscape for NRIs has shifted from incentives to compliance. The era of easy, indexation-boosted returns on passive real estate holding is over. However, the international treaty network remains a robust shield for the organized, documented, and proactive investor. The astute use of Section 54 exemptions, strategic tax loss harvesting, and assertive claiming of treaty rights can neutralize the aggressive domestic tax code. At EPK Capital, we believe wealth preservation requires coordination among your advisors. The difference between a passive NRI and a strategic NRI is often 20% to 30% of the portfolio's value over a decade. That is the difference between merely being rich and building wealth for generations. The blueprint is before you. The time to act is now.